Hello, everyone. Trevor Damian here, commercial mortgage broker, president and founder of California Loan Servicing. We're based in Los Angeles, California, provide commercial real estate loans nationwide to investors and developers, both on the permanent and structured side of the business, utilizing capital market resources such as life insurance companies, debt funds, banks, and credit unions. Half our deal flow is based here in the Southern California area, the rest nationwide. Our average loan size is about 15 million. We'll go as low as 2 million, up to a couple hundred million. As part of my goals for 2023, I thought we'd make more of a presence on social media, start with some videos. Ideally, we're going to be moving forward with a monthly video closer to 5 minutes. This one may be a little longer as it's our first one and there's a lot to talk about. I thought we would start with speaking about the yield curve as everyone's talking about inflation and what the Fed's doing to curb inflation. The bond yields charted in the yield curve are the core to commercial interest rates. Most lenders apply a spread over them to calculate what your commercial interest rate would be. So I thought it would be appropriate to dig in. The US Treasury yield curve. So I pulled this from the internet. I think our government probably put it out. This is today's yield curve. We're at a 3.8% overnight starting rate with a peak of about 4.7 on the 6 month and a steep decline, which means the yield curve is inverted, which means there's a very high probability that we go into recession based off the history of the yield curve being inverted and every other time we've been in a recession. Typically, you can tell as there's a lot more risk and higher yield associated in the short term, next 6 months to a year, versus as you go out further, there's less risk and less yield to be realized on those type of investments should you purchase one of those fixed term assets. But let's walk back to where we were when things were normal, when the Fed said this was transitory, the inflation I'm referring to. January 1st-ish. Nice steep yield curve. To kind of walk you through what we're seeing here, we have percentage on the y-axis and bond maturities on the x-axis, starting with the shorter term, going all the way out to the 30-year. A lot of your commercial real estate loans are either 3-year, 5-year, 7-year, or 10-year fixed. If you were to get a 5-year fixed commercial real estate loan on January 3rd of 2022, the 5-year treasury was 1.37. Maybe you had a 200-point spread over that bond yield, so you would have locked in at a 3.37 interest rate for the next 5 years. Congratulations. Let's go ahead and take a snapshot of this yield curve. Now let's fast forward to February, 1 month later. You can see the yields across the curve increased. So bonds are viewed as one of the safe haven investments in the world, the US Treasuries specifically. And anytime there's turmoil or some type of depression, recession, a war that takes place anywhere in the world, businesses, governments, individuals move their money towards the US Treasuries as it's a safe haven. One of the lower returning investments, but a safe investment. At least you know you're going to get your money back. So people start moving their money to like real estate, stock market, cryptocurrency, other investments when times are good, as they want to achieve the highest returns possible and are willing to take a little more risk as the global economy and things generally speaking are rosy. But when things are not, people move to safe haven investments like bonds. So when people buy bonds, yields go down. When people sell bonds, yields go up. Take a snapshot of that, and let's move to March. Okay, slight increase in the bond yields, the short term, and then we've crossed here and we've seen a slight decrease in the yields in the longer term. What is that telling us? A little more inherent risk, maybe in the next 3 months to 2 years, a little less risk or unknown relative to where we were before, maybe your 5 to 10 year period of time. Let's go ahead and stick a pin in that and move on to April. Now, I believe this is when we experienced our first rate hike. The Fed meets 8 times a year, and we experienced 7 rate hikes this year. This first one was a quarter. It was on March 17th, and our federal rate went from 0 to a quarter point. First time in years. So that's kind of what you see here at the very, very beginning. But we've seen a lot of activity now in the curve. The yields have significantly increased, starting around the 2-year, all the way to about the 10-year, and we're now starting to see a slight inversion. And historically, when the yield curve inverts, it's indicative of a recession. But just slight here, very slight, where the longer term maturities yield less than the shorter term. Stick a pin in that and move on to May. In May, we had another 50 basis point increase anticipated. Now our short-term money, our floating rate money, your credit cards, car payments, floating rate, commercial interest rate debt, that cost now has gone up. The cost for banks to trade money has gone up. Everything across the curve has gone up. Some areas relatively higher than others. The short end of the curve, every time that goes up, it carries the rest with it, generally speaking. Let's put a pin in that. June. Okay. Slight increase in your real short-term money as the Fed now has increased our first 75 basis point hike. This could be the first of 4. Inflation's red hot, and they're doing their best to curtail it. As you can see, we're starting to flatten out even further in this kind of 2 to 10 year period. Stick a pin in that. There we go. And move to July. Now the yield curve is fairly flat, right? Again, another 75 basis point increase realized. That floating rate debt, variable debt is going up. The rest of the curve is going up with it. We're now fairly flat, a lot of unknown, a lot of uncertainty. Will the Fed be able to curb inflation? Jobs are just red hot. Employers just can't find good candidates, paying them tons of wages. Rents are up. Vacancies are low. All right, let's put a pin in this. Let's move on to August. Now we're starting to see some inversion. Look how high we are now on our overnight. We're now at basically 2.25. All this activity in just 6 months. It's amazing. And now we're seeing some serious inversion. We're inverted all the way from the 1 to the 10 year. So now our length of our maturities, the inversion is even longer and steeper, giving you a stronger indication. Save that. September. Okay, September 21st is when we're going to realize our third 75 basis point rate hike. Still, I believe, widely anticipated. Still trying to curb CPI. And we're fairly flat, if not slightly inverted across the curve. And yields in general are much higher. October. Now we've realized our 75 basis point increase on September 21st. Our overnight's 275. Yield curves across the board are higher. We're still slightly inverted between the 2 and 10 year. November. Okay, now we've realized, well, we're about to. There. Now we've realized our third 75 basis point increase. Our overnight rate is about 3.75. We're inverted, about the same steepness, or decline, I should say, of inversion relative about 1 to 10 year from previous, maybe slightly more increased in the shorter term. And let's just skip to today. Why not? Now we're seeing a serious inversion in the yield curve. Not much change here on the short end, but the treasury yields really dropped from your 2 to 10 year period in time. They've slightly come up just because I look at this stuff every day, probably 10 times a day in the last couple of days. But I'd be very interested to see historically how many times we've had such a steep yield curve and what type of time length there was and the impact of that recession relative to the yield curve. It'll be interesting to see which direction the yield curve goes from here. I've spent nearly 13 minutes of your time. I've gone way over the 5 minutes that I promised and will commit to you in the future. I hope you enjoyed some of this material. Hopefully you could relate to a little bit, maybe learned a thing or two. I know I learned a lot as I tried to research and kind of put a lot of this together. But feel free to reach out to me for any loan inquiries, questions about what's going on in the marketplace. Happy to review your portfolio with you, look at different strategies, and have a happy holidays, happy new year, and we'll see you in 2023. Thank you.